The April jobs report just dropped and it shocked everyone from economists to investors. What it revealed was pretty clear. The labor market is slowing. Before its release, Wall Street analysts had expected that the US would add around 240,000 jobs in April. The number that came out today showed 175,000 were added, meaning that the mark was missed by 27%. This sent shockwaves throughout the industry. Unemployment also jumped to 3.9%. Now, instead of the market falling as you would think happens when we see job creation declining and unemployment going up, the S&P 500 actually jumped by 1.23%, soaring 500 points. Why? Well, as bad as this sounds, Wall Street actually enjoys these facts. On May 1st, Federal Reserve Chairman Jerome Powell held a FOMC press conference where he made a couple of statements that changed the sentiment in the markets. One of the first things he mentioned is that it's unlikely the Fed is going to raise rates. Specifically, the quote was, "I think it's unlikely that the next policy rate move will be a hike." Before this meeting, a lot of people believed that the Federal Reserve was going to have to continue hiking rates because of these strong inflation numbers we kept seeing. As I mentioned in my last video, inflation is sort of stuck around the 3% mark and it's refusing to come down to that 2% goal. But his statements went even deeper than that. He also mentioned that we're also prepared to respond to an unexpected weakening in the labor market. Now, obviously, a lot of people perceive that to mean that if the job number goes south, the Fed will cut rates. And this brings us back to what I was saying earlier. The reason the stock market jumped on a bad jobs report is because it's becoming increasingly apparent that Powell is not going to hike. He's going to cut. That's at least the perception out there. It seems like Wall Street often sees bad news as good news. But does this mean we're actually moving towards a weaker economy and job market, one that would make the Federal Reserve cut interest rates again? This was the reaction of Gary Cohn, IBM vice chairman, on CNBC yesterday morning following the job announcement. And he's pretty clear that this is a good number and that Wall Street sees it as a step in the right direction. You can hear him expand on these points in this clip.
Joining us now, IBM Vice Chair, former Director of the National Economic Council, and former Goldman Sachs President, Gary Cohn. Welcome back.
Thanks for having me.
Great day to have you.
Perfect day to have me.
So, do you rejoice with the markets over today's jobs report?
Look, I think it's a very good number for today. It's just one number. And I remind this, and we've had this discussion here, it's one number. One number is a point. If we get a second number, we'll have a line. If we get three numbers, we'll get a trend. So we need to get three numbers in the right direction to get a trend. And also, these numbers are not science. They're art form. These numbers are subject to revision. We've talked about revisions a lot. The market hangs a lot on these numbers, and these are numbers that get revised and sometimes get wildly revised. We saw revisions down from last month. This number seems pretty consistent, though, with what we're seeing in the JOLTS data and other data around. And this is a number that's pleasing to those of us that sort of hang out in the markets. You know, the Fed will be happy with this number. It shows a cooling. It shows their interest rates having an effect. Market practitioners and people that trade the market feel like this is a good market because it puts the Fed back where they want to be. It puts them on a trend towards lower interest rates. And we're seeing, as you said, we're seeing wages come down, but wages have now sort of equalized with inflation. So we're not seeing a loss of purchasing power, but we're not seeing a gain of purchasing power. So it sort of lands in a good spot for now.
Does it give you confidence that the inflation numbers will start to come in worse than expected, which is something the Fed needs to see?
Look, Sarah, it's a number. It's a start. Hopefully this is a start of a new trend. There's a start of a trend of sort of tackling that last mile that we've talked about. You know, getting inflation down from 9 to 4% or 3.8%, that was relatively easy. Getting inflation down from 3.8 to 2 and 2 and below 2, that's difficult.
Okay, you just heard Gary say and emphasize the fact that this is just one point, but it's actually part of a greater body of evidence that is starting to form a trend. One other aspect that analysts on Wall Street are looking at is earnings reports from various companies. Take Starbucks, for instance. Its stock dropped more than 17% in just 2 days after revealing that same-store sales fell 3% and traffic fell 7%. The CEO in their earnings call said, quote, "In this environment, many customers have been more strict about where and how they choose to spend their money." And this fact may not seem like a big deal to a lot of people, but it sort of gives you a portal into how people are behaving right now. If they're choosing to spend less money on overpriced coffee, it can be said that the things out there from the consumer side are changing rather quickly. I don't think Powell being dovish was a coincidence. He was aware of the situation on the ground probably more than anyone. There is now more and more evidence that things are weakening, and it's even showing up in the job market calls. If you take a look at ZipRecruiter as an example, they've been very clear with their shareholders. Things are not exactly great in the job market. On the earnings call, you can hear their CFO say the following: "Our fourth quarter revenue of $136 million represents a 35% decline year over year and is reflective of a continued soft hiring environment." It cannot get any more precise than that. There's obviously some sort of problem that is influencing not only spending, but jobs as well. Now, you may say to yourself, well, all of this is BS because the unemployment report says that we're at near record lows, and that is true. If you look at the chart, you can see that we've been moving up since about January of last year, but we've crept up so slowly that even zoomed out and compared to other periods, this looks like no reason for concern. However, I would not rest on this way of thinking. Let's look at the year-over-year change in unemployment on a chart. When this chart peaks, indicating the fastest change in unemployment compared to a year ago, it often signals the end of a recession. In essence, peak unemployment is the best time to buy stocks because an economic turnaround is likely just around the corner. Take the 2007 recession, for example. Unemployment changes peaked in April 2009, marking the beginning of the economic recovery. From there, the market started its long upward trend, signaling a massive recovery. However, the real impact of a recession is felt by people well before these peaks are visible on the chart. Unemployment can spike suddenly, often preceded by smaller indicators supported by other evidence we've discussed. So this is exactly why you're seeing people worried. They read these consumer spending reports, the job market report, and they see unemployment tick up, and they think this is how it begins. Rightfully so, as history has proven that typically this is how it slowly starts to happen. However, on the brighter side, there are positives. As I mentioned earlier, the Federal Reserve will lower interest rates if unemployment becomes unstable. This action can greatly benefit businesses, the stock market, and job creation. If Chairman Powell times this correctly, the current slight economic weakness could be quickly mitigated by the Fed's interest rate adjustments. And to make it even better, it wouldn't even take a Fed cut to do this. Right now, even the perception that the Fed will lower rates at some time in the future is enough to push the market up significantly. As we saw with the S&P 500 this week, actual lower rates would mean cheaper mortgages and a boost in stock market values, which would obviously have an even greater effect in propping up this entire economy. The challenge for Powell is balancing the prevention of a recession with keeping inflation low, a nearly impossible task as one often impacts the other. The good news is, with interest rates at 5%, there's room to adjust them as needed without causing significant disruptions. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below what you're seeing at your job. Is there weakness in the market, or are these just overreactions?